Yes, you read correctly. The Fed are not going to pivot. In fact, they are going to continue and increasing interest rates, and I'm going to show you what you should be aware of and what you should be doing about it. First of all, most of you need to understand that if the Fed could, so far they would have continued increasing interest rates. The only reason they have not is because just recently we saw multiple banks start to collapse and we saw lots of fear and panic in people's minds simply based on the increasing interest rates. While simultaneously we saw the CPIs dropping, and now we're being at 3% inflation. How can we justify 5.25 interest rates? In fact, I'm here to tell you that the market is going to take a big beating simply because they're not just not going to pivot, they will be continuing. And I'm going to lay out the exact schedule that I think by which they will be doing that. Now, here we are, as always, looking at the SPX chart, the S&P 500, and were there any hints on the technical level? You're probably asking yourself, and I'm going to show you that there were some. And in fact, they show that things are going to get painful, but they're not going to get as painful as most people think. Now, let me just add a couple of tools to the chart. Now, I want you to pay attention to the clear trend that we're in and have been in for quite a long time. We basically landed within this trend right after the 09 crisis. Immediately after that, while we were correcting, we landed into this channel and have been in it since roughly around 2011, as you can see. So, of course, there are some deviations. And nowadays we are here. We're basically at the median center line of the trend. We are literally residing right above the trend line, which is great because I've been saying all along that we're going to see some sort of head and shoulders pattern. It's not necessarily going to be as beautiful and textbook as most people are familiar and usually see, but it ended up working quite well so far. But I want you to pay attention to these areas, just as we had entanglement of the price action within the channel, sort of switching from channel to from the top to the median. And right here, as long as we are going to test this successfully, we're probably going to take the upside. But as you can tell, even that process within itself is never smooth. Nothing is ever linear in the market, meaning we broke down, we climbed back up, broke down again. So very not narrow, as you can tell. Just to kind of give you a hint of the levels here, we're looking at all the way from 4,124 and back up to roughly the areas of 4,544. So as you can tell, quite a wide range. And right now, following the SMMA, we are significantly extended, and if you are looking at any proper momentum indicator, you will be able to tell that this pattern that was happening right here, that looks like a bunch of individual waves, if you sort of look at it in the quarterly chart, you realize all along, again, to every time frame, we have a bigger picture to what is really going on. As you can tell on the quarterly chart, what happened is we have hit the top resistance, pretty much very different from the one we get to see on the monthly. Okay, so right now there is natural resistance, and in my assessment, as you can tell by the diminishing momentum, and as you can tell, it's not linear, meaning we did not break down in a linear fashion. Rather, we're kind of losing momentum. Now, basically, this part, it's a part of losing momentum. And although it is very gradual, we are still probably gonna see, in my opinion, so justifiably here you can tell the losing momentum justifies and gives us more reasoning to think that there is something and has been coming for a while. Now we finally have fundamental justification if we consider the fact that the CPI had dropped to 3% for no good reason. What does that mean? That means that the consumer goods really have not dropped in price. Most people, if you ask the average American consumer, they will tell you that they feel anywhere between 5 to 6 The lucky ones can say maybe it's slipping slightly below the 5, but nobody will hint that inflation currently feels to them as if it's at 3%. Now, the Fed clearly stated they want to get back to 2% inflation, to normality. And they're not going to stop, and they said very clearly that they rather go beyond rather than underdo, okay? And then they'll have to restart, which eventually this process of back and forth can cause a far worse recession in the long run. So they know it's better to overdo than underdo in this instance. So it's far more justifiable, because the only reason for CPI dropping so drastically throughout the last period is because our comparison so far was happening to the increasing into the peak. Last month, last comparison was happening to 9.1. From now on, we will be comparing to diminishing CPIs. So basically the results will be smaller and smaller and smaller. Now, to say that this is within itself just justifies the Fed not pivoting yet, I will tell you that the Fed, very much like a doctor, administered all this medicine, and they will not continue pumping the patient with medicine while not seeing results. So we are about to get to a terminal level at which, if you guys can remember, at Jackson Hole, Jerome Powell hinted at 625. I cannot recall the exact words right now, but I remember he gave a hint and sort of used very tactical words to imply that we maybe will be able to see 6.25%, and saying that the terminal level basically will probably have to increase. So my assessment, the Fed will continue with this path of 25 basis points, and we basically are going to see interest rates go to 5.5, 5.50. Okay. Now, as I promised, there is something you guys can do about it, because justifiably most of you are sitting on some gains after realizing the bottom, realizing, probably listening to some people that gave you hints, or deciding on your own to start participating in the market. Plenty of larger caps have ran up, and you're sitting there and confused and don't know what to do. So again, this is not financial advice, it's for you to decide, but I will tell you what I would do in this instance if I was in a similar situation to you. I would look, first of all, at liquidating a third of my position. It will allow you, regardless of how the market plays out, you will feel a lot better, especially if you're sitting on gains. Depending on how long you're sitting on this position, and if you have any potential of getting out your original investment, so you'll end up playing with house money, as we like to call it, that is the preferred and preferable situation and preferred way to go, in my opinion. Another thing you should be doing, in my opinion, is setting up and tightening up your stop losses and your take profits. Now, not too tight, because if you're going to tighten them up too much, the simple everyday price action and market behavior will throw you out. Okay, so you need to be tight enough for you to be happy and basically retain, if it is your 70% ROI, if it's your 80, if it's 60, it doesn't matter. It's sometimes better to get out with so-called 90% gains instead of waiting for 10 more, just 10 more, and then end up losing 20 or 30% out of your gains, and only then realizing you should have jumped out, and by that time probably the market is already pivoting. So basically you're not in sync with the market. So it's smarter to at least position such stop losses and take profits that, worst case scenario, if the market does tumble down, you will be safe. Now, the levels that I'm looking at currently, first, as you can imagine, there's not a singular level. There are plenty of levels on which we can probably get stopped. Pardon me for that interruption, ladies and gents. That is from our amazing Discord that I highly recommend everybody check out. So, pardon me for all that noise. Now, yeah, I'm not going to try and delete that. Let it just be. Pardon me, ladies and gents. But what you need to understand that there are several key levels that we already went through, and in my opinion, we might very well retrace back to. Pardon me, this is the chart I was looking for. Wrong chart. Here it is. So the key level I'm looking at is basically around 4,200, around that levels, and I'll explain why. Currently, if I'm using the SMMA, because I'm sitting on the, pardon me, let me switch to the monthly chart. I want to be using the SMMA of 20 to 7, basically the yellow and the blue line. In my humble opinion, in my experience, I can tell you, and from the indicators and what I can tell basically from these, that we're not going to conquer this level. And with taking in consideration the fundamental events, that I'm certain that if the Fed will continue increasing interest rates, we will probably see the price action take a dive, essentially, right? And I've been saying that for quite a while. I have been slightly early, but you have to say these things in advance, otherwise they will make no difference. So, in my humble opinion, we might still test the 4,200 level. Why am I saying that? Although our support is currently residing at 3,900, now I don't think we will go that low. I do think what will happen here is, remember, the SMMAs will continue climbing even if if the price action goes down. So I do think the Fed will continue increasing interest rates. Thus, the market will get very scared, and I'm pretty certain they will do that, because now that we've got the banks reported just recently, and they've reported they're doing very well, that probably means the Fed have green light to put them through some stress, essentially. Okay, as simple as it gets. Now, what I think will happen once the market does dive down and will break through various supports and resistances that we've created and had all along. I'm not going to focus on these. They're irrelevant. There are plenty of them in between. I'm going to focus on the SMMA. The SMMA itself currently sitting at 4,187, as you can tell. And our 20 is sitting at 3,900 and, well, 30 something, that level. Basically very close to our fib level, coincidentally. 3,930, you can see right here. Some would say this is a very pivotal level, the 78% retracement. I'm not going to focus on this right now. My students know exactly what I'm talking about. This is a very important level. Now, what I will say here is that, in my opinion, first of all, I know these lines will continue climbing. And what will happen here, the price action will converge on the SMMAs. What originally will happen, in my opinion, is that we'll get stopped and entangled by the 7. And that depends on the lack of confidence in the market post the original drop, which I'm certain we will start seeing very shortly on the 26th, in fact, when we have the FOMC meeting. And then, sadly, I do think the market will break down, and by that time, if I'm correct, what will happen is this SMMA, the 7 SMMA, basically measuring 7 candlesticks backwards in this instance, because we're on the monthly chart, we're measuring 7 months back, so that's quite a decent portion of time to measure and try to get your measurement by, basically. And in my opinion, what's going to happen here is that we will break down, meet the 7-month retracement, and then by that time we'll have the 20-month retracement slightly higher, roughly meet that level, the 4124 that you can see that I'm pointing at right now. And if we're lucky, in fact, this really does depend on how quickly the SMMA will climb, which does depend on the previous price action. If we're lucky, we might get this support, this moving and gradually increasing support, get slightly higher than this, which should be roughly around the 4,200 level, which is a psychological level and has multiple strong supports that we've tested all along throughout the last couple of years. And in my opinion, what will happen is that we will get stopped by these levels. If we're lucky, we might get slightly better results, meaning get stopped at higher levels, maybe 4,300. But I've been saying all along that we are due for a correction. This is very rapid. And coincidentally, the market, although not very clear and not very noticeable to the naked eye of most people, basically. There are areas in which we get stuck, entangled, and channels in which it takes time to break out and successfully continue on our path. So basically, my thesis stands as it was. I do think that we will get to see previous highs of the market. I'm talking about the 4,800. Sadly, only on in Q1 24, somewhere around here, somewhere around January or February. Hard to tell right now. This is far ahead of us. But I do still think we will end up testing some of these levels. I'm not saying we're going to go all the way down, but I am saying we will test some of the levels right here, almost with high certainty. Maybe we're talking about the 4,300, maybe about 4,250. I was saying all along, in my opinion, it will be around 4,250. That's my personal opinion. You do with that what as you wish. Of course, you're all big boys and girls. You know how to manage your money. And from here, guys, I hope this really helps and gives you a perception of why we're ahead of somewhat troubling times. Now, does that mean from here we crash back to 3,900 and the end of the world is coming? I assure you there will be plenty of money managers who will tell you exactly that in the upcoming months. In my opinion, that's not true. This is just a pullback and a normal process. In fact, I can tell you that I've sort of broken down that schedule that I've mentioned before. In my opinion, what's going to happen here in July, we're going to go from 525 interest rates to 550. Then in September, we'll go to 575. Then in October, if conditions still require, we will go to 6. And if so, if they will still think it's necessary, they might take a leap and make it to 625, that terminal rate, but that potential terminal rate that I've mentioned earlier in the video, in December. That will postpone that highest high slightly. Like I said, that's why we might see it only in around February 24. Okay, this is my current opinion. This is not financial advice, guys. I hope to see you all in Tom Nash's community. We are doing plenty of Zooms, amazing giveaways. I highly recommend you all join and participate. It's an amazing community. We talk there about anything and everything from stocks to cryptocurrencies to right now Tom has an academy in which he teaches how to do proper DCF and proper value analysis. As well as you guys, you can see, we just have fun from time to time. We just hang around. We post music we like. We just talk about random topics, sort of hang out, post all sorts of weird stuff and have fun. As well as you have the members area, and you have the public area, which is, by the way, is very important because it's open for everybody and anybody, and everybody can join and have fun and participate and learn a lot. This is a great community with great people. I highly recommend you all give it a go, and if you don't like it, you can always just jump out. I hope you all guys have a wonderful week, and I hope you're gonna have a wonderful weekend. I know it's a bit worrying what I told you in this video, but better to know and be ready than not to know at all. With this, guys, I hope to see you in the community. Peace out.